Thank you, Florence. You are saying that in MM1, one thing that we remember is that the value of levered farm is the same as the value of unlevered farm. Another one that you remember? There is 100% payout ratio. 100% payout ratio. That is the dividend. Any other thing? Farm is made up of debt and equity. The farm, the structure is only debt and equity. The company structure can only be debt and equity, meaning that they are ignoring preference shares. They are ignoring preference shareholders or shares. So they're assuming that the company can only have the debt and equity. Another assumption that is very important. One more assumption of MM1. The value of debt is cheaper, hence a company is liquidated, the debt holders are paid first. Okay. Another one that we always remember, that you need also to remember, is that taxes are zero without taxation. Thank you so much, Professor. That is what I've been waiting for. So why are we saying that the VL is equal to VU? We are saying that the VL is equal to VU because tax is zero. That is what makes them equal. Because when you go to MM2, we always say that the VL is equal to VU plus DT. Now, if T is zero, then it means that now VU is equal to VM. And that is where MM1 comes from. That is the difference. MM2 believes that VL is equal to VU plus TD. That is a while with taxes. But when there is no tax, so the tax is zero, then it eliminates the whole of this. Therefore, this one is equated like that. And here we are referring to MM1. Thank you so much. So let's look at this one. When we are saying that MM1 assumes that tax is zero or there are no taxes, it assumes that taxes are zero or there are no taxes. So therefore, VL is equal to VU. I want us now to look at the value of A. A is levered farm. And then we also have B, which is unlevered farm. So where do we start from? Without taxation or MM1, both levered and unlevered are the same. In MM1, whether you are levered or unlevered, there are no differences. So they are the same. And that is why we are now saying that since the value of the company, we normally get it through EBIT minus 1, right? Into interest, then 1 minus T all over VL, all over KE, all over KE. Our EBIT here is, how much? How much is EBIT?
25,000.
25,000. So if you are getting 25,000, so 2,500 actually. So if you are getting the value of unlevered farm, then we have EBIT minus, there is no interest because unlevered farm does not have interest, and there is no tax. So we have zero tax all over KE. That is for unlevered farm. Then now we are having value of unlevered farm, which is equal to EBIT is 2.5 all over 2,500 is 0.25. What do you get here? Adjust the board. So what do you get there?
$10 million.
You're getting 10?
10 million.
10 million.
Mm.
Okay, another person? Is it 10 million? Do we all agree that it's 100 million, 10 million? Yeah, you can unmute yourself as long as where you are is quiet. As long as you don't make noise, then it's okay to remain unmuted.
Dennis, let me introduce my good friend Agatha. She's a good friend of mine. Waziri is complaining that she has not muted. I'm the one who invited her because the class was free. Agatha, feel welcome and you can mute.
Okay, thank you.
I was just addressing that. I also noticed that she's new, and what we are saying, as long as your background is clear, there is no noise, then it is fine. What we don't want is interruption. Sawa. But kama uko sawa, then you can just unmute yourself and proceed. So, and then you can also unmute yourself when you want to talk. After talking, just mute yourself back. Sawa. So, Waziri, thank you so much. So let's get the answer here. What are we getting? I want to tell you how you can answer this question. When you are told specifically to use MM1, they are very specific, MM1. So MM1, we know the formula that we normally use to get the value of unlevered farm. And in MM1, we are saying that value of unlevered farm and value of levered farm, they're the same. So get me the one for unlevered farm. What do you get? Is it 10 million or 100? 10 million. Huh? $10 million. Thank you. Fine. So that's what you're getting there. So after getting this, normally the reason why we are saying that the value of unlevered farm is different from the value of levered farm is because of the advantage of tax that we normally have or tax shield on interest. Now, in a situation where we are assuming that there are no taxes, then that is in MM2, MM1. In MM1, they are the same. So you can conclude here and say that according to MM1, the value of unlevered farm is equal to value of levered farm. According to MM1, you're right there. According to MM1, value of unlevered farm is equal to value of levered farm. Value of unlevered farm is equal to value of levered farm. And therefore, the value of B that we have calculated, this one, the value of B is equal to the value of A, which is 10 million. Therefore, the value of B is equal to the value of A, which is 10 million. The value of B is equal to the value of A, which is 10 million. So we can proceed. The next part is about MM2, which we are talking about here. So that is how you solve the first question. Just get the value of levered farm, then you equate them, because according to MM1, they are assumed to be the same. The question is this one. Ni hii. Haiko kwa past paper. It is this one here. This is the instruction, and this is the question. So the next part is determine the work for A and B using MM2. What do you remember about MM2? What do you remember about MM2? MM2, the tags are normally given. So you say MM2 has got tags. So you say that MM2 assumes MM2 assumes an environment. MM2 assumes an environment. MM2 assumes an environment of corporate tax. MM2 assumes environment of corporate tax. Florence, what you are trying to do is what I started with. The formula for getting value of levered, you say VL is normally VU plus DT. And since T is zero in MM1, then this one is now not there. Therefore, these ones are equal. Achana na hiyo hapa. If you are working specifically with MM1, I know what you're doing. You are using NI, where you are going to replace interest here. With MM1, we are saying that V, B, and VA should be the same. And the reason why they're the same is because if you were to calculate VL, which is equal to VU plus D, then in MM1, we are saying that DT is 0. That now makes them remain equal. What you're using, you are using net income approach where na hapo ndio shida inatokea. Sawa sawa. You're not using MM1. So let's proceed. We are now using MM2. We are saying that in MM2 assumes an environment. MM2 assumes an environment of corporate tax. It assumes an environment of corporate tax. And therefore, VL is equal to VU plus DT. VL is equal to, that is now MM2, is equal to VU plus DT. And tax is given 30%. So therefore, you can be able now to calculate it using that. So I want you to proceed and say, under MM2, the value of a levered farm is always higher than the value of a levered farm because of tax schedule. Under MM2, the value of levered farm is always higher than the value of unlevered farm because of tax schedule. We put it in bracket and say, interest is tax allowable. Interest is tax allowable. Under MM2, value of a levered farm is always higher than the value of unlevered farm because of tax schedule. Because of tax schedule. Yes. Welcome, Techno. The new guys who are joining us, feel welcome. My name is CPA Dennis. I like teaching Advanced FM. So, in bracket, interest is tax allowable. Interest is tax allowable. So that means that under MM2 we consider tax. Under MM2 we consider tax. And of course, you have to start by getting the value of VU, which we are saying that VU is equal to EBIT all over KE. And this one here is KE over unlevered farm. If this one is unlevered, then even the cost of equity is also unlevered. So therefore, we are saying that VU is equal to 2.5 M all over 0.25, which I think we have gotten this one to be 10 million, right? We have gotten it to be 10 million. That is what we got as VU. Now we are using MM2. Up to there, are we okay? Are we okay up to there? 10 million? Or somebody's getting something else? So therefore, you can proceed and now calculate the DT. So we are having our VL as 10 million plus we have our debt here. So debt is 1 million times 0.3. That is the tax. So what do you get as the total? That is the tax. So you're getting this one 300,000. So it is 10 million 300,000. I hope that we are together there. Remember what we are told to calculate is work. But for us to calculate work, you need to know the cost of equity, you need to know the weight. You know, normally work is WE KE plus WD KD into 1 minus T. Sindio? Is that the correct formula? Now, you need to get the weight, and for you to get the weight, you need to know the value of equity for that unlevered farm, So you need to know the value of equity and the total value. You need to know the value of debt and the total value. That is why, first, we need to know the value of the whole farm when it is levered, so that our weight should be equal to, weight of equity should be equal to equity all over VL, the value of levered farm. So we need to know this. The reason why we want it, so that it can help us get the proportion, which is the weight, which we can now use here to get work. Are we together? Now, we know that BL is 10 million. But BL is also the same as equity plus debt. It is composed of those two, equity plus debt. It is composed of equity plus debt. So what we are saying is that the value of the farm is made up of the total debt that you have and the total equity. So that is the summation of these two. So now that we know the value and we know what debt is, can we be able to get the equity? So you proceed and now say that equity is equal to VL minus debt, where now we have the 10 million, 300,000 minus debt. Debt was how much? 1 million. So what is the difference is 90. That is our equity. Are we together? Yes. So that is equity. Now from here, you can get the weight. Whenever you are asked about the work, you need to get the weight and the cost. So we are working on the weight first, and now we can get our weight. So WE is equal to 9,300 all over 10. What do you get there? And WD is this one here. What are the weights? Why are we not using taxes to compute value over unlevered farm under MM2? Under MM2. Can somebody tell us why we are not using taxes? Topisa is saying that I'm confused somewhere. Why are we calculating the value of livered farm using the value of unlivered farm plus instead of MM2? Okay, so let's start with the first one. Can somebody tell us why we have not used taxes there? Mbona tujatumia taxes? That question is almost similar with what Topista is saying. So Topista, this question that you're asking is the same as what Agatha is asking. MM2 does not give us the formula for getting value of unlivered farm. MM2 alone does not. So we borrow that from MM1. So, and in MM1, there are no taxes. MM2 only gave us two formulas. The first formula was for VL, which is the value of livered farm. And they are saying that the value of livered farm, according to MM2, there are two formulas. Value of livered farm that we are given, which is the same as VU plus V plus VTU. Where you're going to get your VU, they have not said. So you have to borrow that from MM1. And MM1, there were no taxes. Agatha asked the same question. Why are we not including taxes when we are getting VU? Because we used the formula in MM1, which does not have taxes. So we are getting our VU without using taxes. But then the tax element comes here. This is where the tax element comes in only. And that is why now VL, instead of it being equal to VU, it is a little bit higher because of the tax shield on the debt. So the tax is applied here, and that is what makes it a wall with taxes because of this debt element. So that is where we are. So we can proceed. We can now proceed to get the weight. You know, the examiner is very specific. If the examiner tells you to use NI, then you know what you're supposed to do. When you're told to use NOI, you know. If you're told to use this one, MM, then you also need to know what are applicable here, MM1. So we are having 0.1 and 0.9. So here 0.9, we have 0.1, 0.9 and 0.1. I hope that is okay. Now we have the weights. The next thing is now to calculate our cost of equity. So we now need to calculate the cost of equity. Cost of debt, we know. Cost of debt is given here. This is the cost of debt. But cost of equity of livered farm, we don't know. Because we are using MM2 to calculate the cost of equity, we are using MM2 to solve what? MM2 to solve what? We have to use the formula that we are given in MM2 to calculate the cost of equity. Which formula was it in MM2? Do we remember the formula? The examiner is very specific. Use MM2. So we are going to use the formula in MM2 for cost of equity. What is the formula? Cost of equity of livered farm. Someone to say it. You remember that formula? There's something that is still missing there. Florence, you tried, but that is not the old formula. What is missing there? That formula is not complete.
Okay, that formula reads KE levered is equal to KE unlevered plus into bracket KE unlevered minus KD into bracket debt over equity summation of, not summation, but into bracket 1 minus T. But Dennis, that one you said we can use it where we have different EBITs.
Different habits.
Yes, that's why I'm disputing that, and I am giving you the another one that we can use where we have.
Hold on, I said where we have different habits, it is the preferred, because we have so many formulas, it is the preferred. But I didn't say it is only used. No, I said it is the preferred. That's number one. Number two, it is the one that we are given under MM2, and the examiner wanted us to use the formula for MM2, use MM2. So you need to understand. So there, we can now proceed and get our KEL. So if the examiner is specific, don't use the other one. You can get KEL, we know, but just use the one for MM2 because the examiner is specific. So this one, our KD EU, we have it here as 25 plus in bracket 25 minus KD is 8 into debt. Then now we have there 1 all over 10.3 zero, and then times 0.7. What do you get? What do you get? So you can start by calculating 1 over 10.3 times 0.7. The answer that you're getting, multiply with the 17. Here is 17. So 17 times the answer that you're going to get here. So what are we getting? Is it 26.9 or 26 point? 26.19. I can also do this. Let me try and see. So we are having 1 divided by 10.3 times 0.7 times 17 plus 25. I'm getting 26.16. 26.16. Oh, sorry. You are right. Here we have 93. That is, I was having here the total set should be 9.3. Okay, now use 9.3. What do you get? Should not be 10, it should be 9.3. Great. 26.28. Huh? So that is the answer, 26.28. Now, in exam, they can use any percentage here. They can use 2.5, they can use 10%, whatever figure that they have given you, that is what you shall use. I want us now to look at the question that I shared earlier. Florence, now that you know where Agatha is, kindly share with her that question kwa namba yake, ndio tuweze kusonga pamoja. I can read the question. Have you shared, Florence? I think the rest here are our normal students in normal class, so we have shared with them the question. Agatha, do you have the question? Do you have the question? Shares, eh? Also, I'm not sure, Anne, maybe Anne is not having the question, or we have Anne in class. So the question is from December 2020, December 2012. December 2012. Question number 2C. December 2012, question number 2C. And the question says that Best Food Limited, and do you have the question? Do you have it? Thank you. Best Food Limited is a food processing firm which is 100% equity financed. It is 100% equity financed as we speak. Now, normally when you are reading the question, understand the language. They are saying that Best Food is, meaning that currently, as we speak, is a food processing firm which is 100% financed equity. The company's board of directors are considering diversifying the operations by entering into the consumer electronic industry. That is what they are thinking of doing. Not yet, but they want to get into consumable or consumer electronic industry. So right now they are dealing with food. They will go to electronic industry. Now, additional information. The current equity beta is 1.2. Which beta is that? The current equity beta. Which beta is that? 1.2. Is BU. Thank you. It's called asset beta. This is called asset beta, which you can call BU, because it is beta of unlevered farm. It is the current, and currently the company is unlevered, high debt. So the current equity beta is 1.2. So that is better for unlevered farm as we speak. And 1.6 for best food and electronic farms respectively. So when they get into levered, then now the beta will change to 1.6. Which beta is that? That is beta. So this one we can say that B, EL, EU is 1.2, and then B, are we together up there? Waziri, unaona hiyo mambo? They are giving you the risk, the current one. And of course, we know that currently it is unlevered. So if they say that the current equity beta is 1.2 and 1.6 for best food, best food is the one that is currently unlevered. But when we add more debts, it will be levered now. At that point, it will be called consumer electronics industry. The gearing in the electronic industry average is 30 and 70. The gearing is 30 and 70. So if we move to electronic industry, of course, we're going to have debts. The gearing is going to be 30, 70. Currently, we are not there. Currently, we are 100% debt. Yes, Florence. Florence, go ahead and ask question.
Dennis, you are doing an analysis of this question, and I'm not getting additional information. One, they are saying the current equity beta is 1.2 and 1.6 for best food and electronic firm respectively. Tunajua currently wako na Best Food Limited, which is 100% equity. The company's board of directors are considering doing whatever their operation by entering into the consumer electronic industry. I have a question. The BU is 1.2. Why did you make your analysis as in like BL inakuwa 1.6, but they have not stated it here?
Look at the second additional information. What does it say?
The second additional information too is saying the gearing in the electronic industry average to 30 debt and 70 equity. Oh, sawa.
So what is happening is that when they are still dealing with the food industry, they are there as only equity finance. But when they move to the consumer electronics, they are going now to have debts. At that point, the gearing will change. The gearing will change. And of course, the beta that is currently prevailing for such kind of gearing is given there. It is the 16%. That 1.6 is for levered when if they join the electronic industry. So you'll see. Now, thank you. The number 3 says that return on market is 25. What does that mean? That return on market, what is it? What do you understand by that return on market? That is the expected return. If they say that the return on market premium, that could be different from return in the market. Return in the market is the expected return in the market. Sorry, I was assisting Madam to set up class. Now, we are saying that the return in the market, on the market is 25%. So, Waziri, I know topic number 2, we shall revisit. But when you're told that the return in the market, that return in the market is also the same as expected return in the market. What it means is that in the business, there is what you expect to get if you get into that business. Tunasema kama, for example, if you are in real estate industry, what are the average return in the market? It can be expected return or expected return, or they just call it return in the market for everyone. Alafu sasa kuna specific yako depending on the risk level. So that return in the market is this one. Sasa for everybody in that industry, hata kama hujaingia, that is what everybody expect when they join that industry. The risk rate is given, which we call RF, as 10%. Assume that a corporate tax rate is 30% required. Determine the suitable discount rate for the new investment. If the directors were to finance the new project as follows. So when you're told a suitable discount rate, si ati wamepewa discount like offer ndio wanunue. No, it is around a rate for discounting. Like when we are getting our PV fund, we always ask ourselves, what is the discounting factor? Discounting factor requires a rate, which we call discount rate. That discount rate is the cost of capital or the return on investment. Cost of capital or return investment. Remember what we said yesterday, a cost is also a return to somebody. So it is the discount rate. In other words, these guys are now asking you, can you give us the cost? And of course, when you're looking for cost, where we have both equity and we have debt, that cost must be average or the weighted. It has to be the weighted because we have debt and equity. Therefore, this cost that we are referring to, where we have debt and equity, we call it work. So this guy is asking you to calculate work indirectly. They don't tell you calculate work. They are now telling you the suitable discount rate for the new investment if the directors were to finance the new project as follows. So the first one, they are telling you that if they decide to finance it as 30% debt and 70% equity, and that is what you've been given in number 2. It is the current gearing ratio in that industry with a beta of 1.6. This is the current gearing ratio in the industry with a beta of 1.6. Now, it means that we have to get work. So how do we get work? So we want to get work when we have 30 debt and 70 equity. So number 1, you need to calculate work where we have 30% debt and 70% equity. As usual, we know our formulas for getting work. That work, this one is of course, this one is levered farm. So we know that our work for levered farm is weight of equity, cost of equity plus weight of debt. Weight of debt, cost of debt into 1 minus T. How do we get equity? Can somebody now help us to get equity? At least weights we know, cost of equity, cost of equity. So I was expecting to get the cost of, thank you, Agatha. You're saying that we shall use KAPM, their mother's formula. So we are using KAPM. Why do you think we are going to use KAPM? What makes you think that we need to use KAPM? Why do you think that we need to use KAPM? KAPM is used to calculate risk. So we have 4 formulas that we can use to get our cost of equity. And in this one, we've been given beta. Whenever you see beta, always think of KAPM. So, whenever you see beta, always think of KAPM. Always think of KAPM. Again. So, how do we get it using KAPM? We can now start following this one. We are saying that KAPM, cost of equity of a levered farm, says that it is RF plus, in the bracket, ERM, and we are given. Whenever you see ERM and beta, think of KAPM. So we have ERM minus RF into beta of levered farm. If you're getting the cost of levered farm, then beta should be better for the levered farm. Do we have beta of levered farm in that case? Do you have beta of a levered farm in that case? Yes, we are given. At least for the one that has got 30 and 70, we are given the beta of levered farm. Because we are told in number 1, the current equity beta in the market is 1.2 for best food, which is unlevered, and 1.6 for electronic farms, which we realize is levered. The gearing in the electronic market is given as 30/70. So 30/70 is for gearing, and that is for electronic market. Electronic market has given as 1.6. So 1.6 is for levered. So we can get our cost of equity here, where we have RF was given us 10%. So we have 10 plus ERM is 25 minus 10 into 1.6. What do you get as the cost of equity of levered farm, where we have 30/70? We're getting 34%. That's good. So we have our weight. We have the cost of equity. We have the weight here. What we don't have is the cost of debt. What do you think? When we don't have the cost of debt, we are not given the questions. No, we are not given the cost of debt. So what do we think? What do you think you can do? Write a note and say that NB, whenever KD is not given, whenever KD, which is cost of debt, KD is not given, always assume it is the same level with RF. Always assume it is in the same level with RF. Always assume that it is in the same level with RF. Why? RF is a return in the market. It is only that it's for riskless return. It is a risk-free return in the market. So if you're not given the cost of debt, which is the return on loans, returns on debts, then you can take the return that is in the market that does not have any risk. Unless now they tell you that this debt has got this specific one. But whenever you're not given, always assume that it is the same as the RF. RF is the same as the KD. Some examiners will tell you directly that RF is equal to KD. Some will not tell you. If they don't tell you, always assume like that. So now with that information, I want you to proceed and calculate for us now work. I want you now to proceed and calculate work. Calculate for me what? For that one. Assume that now you are able to do it and do it. Proceed and calculate work. So what mean? Pardon, whenever K is not given, not KD, not KE, KD. We are saying that whenever KD is not given, KD is not given, always assume that it is the same as RF. Always assume that is the same as RF. Lawrence bwana, unasumbua Agatha na yeye ni mgeni. Sisumbue mtu kama Ruth hivi, topista ama waziri hapa. Karibisha mgeni kwanza. So we are getting it to be 26.8. That is what Ruth is getting. Any other person who has a different one? She's our last one in this class. She's getting it 25.9. What I like with her, she's very accurate and fast. So but she's very accurate and fast. So let's now try this. We can do it together. So we have our weight. So work is weight. We should have, we said that our weight is 0. Equity is 0.7. So we have 0.7 times the cost of equity. We had calculated to be 34% plus weight 0.3 times the cost of debt. We are saying that it is the same as the risk rate, so it is 10%, which is the same as 0.1 times this one just 10%. 10% times 0.7. So what do you get? What do you have? What do we have? What do we have? What do we have? Mnapata ngapi? Okay, calculating. Topista, what are you getting? So Ruth anasema it is true 25.9. The next part is now we need to get the suitable discount rate for entirely when it is entirely equity. Entirely equity inamaanisha nini? Ruth, what does that mean? What does that mean? Entirely equity. Mercy, are we together? when it is entirely equity. What does that mean? Fully financed by equity. Thank you. It is now fully financed by equity. That is for unlevered farm. And we need to get the KE for unlevered farm, which is now RF plus ERM minus RF beta of asset beta. Asset beta, you can also call it beta of equity of unlevered farm, the same as asset beta. Because equities are assets. So that is why we call it like that. Now, do we have BA? Do we have asset beta? Do we have asset beta? After the mix, remember, what we were given was the asset beta before the change. Nataka uelewe. Currently, the asset beta is 1.2. That is currently. These guys are considering to move to electronics. The first thing they have told us that if they move to electronics, it is going to be delivered at 30/70. What if they decide to move to electronic by having more funds, but not getting them from debt, not leverage? They are having more funds from ordinary shareholders or more equity, so that they move deal but equity financed. When they are not now in best, that one that you're showing me, Ruth, is for best food. Now they are in electronic, they're doing electronic business, but they have decided they are not going to lever it. They are going to have unlevered, but in electronics. So that means that we have to calculate our new beta, not the current one. The current one is 1.2, but next, or the next one, when they move to electronics, when it is fully financed by equity. So that means that we need to get our new beta, that is BEU. So what is going to be the new BEU? New asset beta, which you call BA or BEU. The formula that you are having initially is where you have to apply Amada's formula to get asset beta. The Amada's formula says that the BEL is equal to, can somebody tell me? I want somebody to speak. Kuandika ina take time. Nataka somebody aongee.
BL.
Go ahead. BL. Okay, Ruth, pick it. Topista. What is it?
BL is equals to BU plus into bracket 1.
Plus into bracket.
Yes.
Plus into
1.
bracket. Proceed.
1 into bracket 1 minus T.
1 minus?
1 minus T. You've interchanged it. 1 minus T tena into bracket.
No, start at question. Enda pole pole.
Okay, sawa. BL is equals to BU into bracket kubwa 1 plus, yes, bracket kubwa 1 plus bracket ndogo 1 minus T. Close that bracket. Open another one. D over E.
I open another bracket.
Yes, D over E.
D over E.
Yes, you close a bigger bracket.
Is it that one? Do you agree that that is a formula? Topista, give us the formula. Or is it the same?
Okay, I think that's the formula.
Oh, it is the formula.
BL, yeah.
Proceed.
Into 1 plus into 1 minus t, you cross the brackets, d over e. Yeah, it's the same.
Basically the same. I hope that is what Agatha knows as well. So if that is the case, how do we now get the new beta of asset? Ruth, I want us to agree. What we are given is the current one. But if you decide to finance it, we might have a different beta for the asset. So what would be the situation? So what are we going to do? We are going to have all these. That is the B, EU is equal to BEL or lower 1 plus bracket 1.1 minus T D over E. Right? Florence, did you know that something exists like that? That is a formula. In case you're not even this, you can always calculate. So, how do we get D over E? Assuming that you are having a total capital of 10,000, and in this 10,000, you're told that equity is equal to 8,000, then debt is equal to 2,000. What does that mean? The weight of equity is 8 all over 10, which is 80%. Still. And then this one is 20%. Is that true? Is that true? So if this is the situation, this one is a real capital. This is also capital. But you can get them in form of percentage as well. So therefore it means that we can use this percentage to help us. Instead of now having your weight as 8,000 all over 10,000, you can just have it as this one. So this 0.8, they represent 8 million, which is the equity, 0.8. So therefore, this one you can say that this one is now equal to the weight of debt, which is 0. What was the weight of debt? Someone to give us. The weight of debt is what? With 1.6, the weight of debt was 0.3, all over 0.7. No, so this one can still give you B over E. If you don't have the real values, you can use the percentages. So that when you add this and this, you get 1. See the debt and equity. Debt and equity gives you 1. So this one is the equity, this is debt. This kind of leverage has got beta over levered beta, which is 1.6. So therefore, we can say that our levered beta is now 1.6 over 1 plus 0.7 times 0.3 all over 0.7. This is the same as that. What do you get there as the beta of unlevered farm in that case? We want to prove that it is the same as what you are given there. If there is change, tutaona. Kama ni sawa, tutaona. Ruth alituambia 1.2. Na mimi nikasema inaweza kuwa imechange because over time. So I want to see if it is going to be 1.2 or 1.2 something or 1.3. So it is 1.23. Thank you. Now we have our method of unlevered farm. We can now proceed and now use it here. So you have used Amadas. In some cases, the examiner will not even give you the better of the asset better. The examiner will give you better of levered farm, but not better of unlevered. So it is up to you to calculate better of unlevered. And the vice versa can happen. You can be given any better. Now, unatafuta ingine. Those are the formulas, and that is how you maneuver with it. So come here and now get your cost of equity of a levered farm, where we are having 10% plus 25 minus 10 all over times 1.23. What do you get as the cost of equity of a levered farm? What do you get? I want us to try. Kila mtu ana calculate. Sio mtu mmoja. So Ruth is saying that is 28.46, fine. 28.46. Thank you. Now, let's do the last part. The last one they're saying, what if the ratio changes or the leverage changes to? What if it changes to 40 debt and 60 equity? 40 debt and 60 equity. Thank you. People are getting different answers, so that means that I have to calculate it and see. So we have, that is 15 times 1.2. 15 times 1.23 in a letter 18.45 direct, 18.45 direct. Now that 18.45, you simply add 10, 28.45. Sasa hizi zingine naona zinatoka wapi? Don't mess up your answers because of small errors, because of some small errors. You can be right throughout, then the last minute, you just want to realize it. Okay, so let's do the last part. Which I was reading. So we are saying that now it is, why do we put 10%? See the add. See your formula. So umeshapata hapa 10 times this, then you add 10%. 10% is a risk rate, the minimum. Florence. I think I explained that in our previous class. I'm trying to be keen so that I don't take more of your time past 8:30. Florence, what you are saying, when you invest in any business, there is a minimum return that does not have risk. For those who call risk averse, when you know risk kabisa, that minimum return if this is the return, then this one is the risk. The risk moved from zero raise to maybe around 20, right? The return moves like this. So the rate where the risk is still zero, you can invest without risk, is called risk-free rate of return. So. And free rate. At this point, you normally get them from treasury bills or bonds. Treasury bills or bonds. Those returns do not have risk at all. Lakini kuna wachoyo. There are some people who still want to get more, so they will invest in risky assets. In that case, in their diversification, they will have more assets that are now risky, and therefore the risky part now moves from, in their portfolio, the risky part now moves from here going forward. So from here, you can see the risk level start increasing, right? So therefore, if the expected return in the market is up to here, there is a risk gradient here, there is a risk element here. This is now the area which has got risk. It is necessitated by the fact that he has moved from the risk-free return, he wants a higher return, and that higher return, the higher the risk. The higher the return, the higher the risk. So we are going to give you the guarantee, which is this one, and then the difference here, which has got risk element, and that is why we are saying now the return in your investment is equal to the risk-free, which is guaranteed, this one, plus the expected return, which is this one, this is the expected return, which can be like 20. So the expected return is 20 here or 25. This one is 20, is 10, sorry. This is 10, this is 25. So 25 minus 10, this is the area that we are trying to define. 25 minus 10, this is the area that has got risk. And that is why now that one we normally calculate it with the risk element. With the risk rating or risk of that particular area. You multiply only this one with the risk because it is the one that is risky. This area we call premium, market premium. So if they say market premium, know that they have calculated for you already. Wakikwambia market premium ilikuwa hii, inamaanisha washapata the difference tayari. Kazi yako ni kuchukua hiyo market premium, if it is 8 or 15, take 15 minus the better. If they say it is expected in the market, it means that they are talking about the whole thing. So you take 25 minus 10. This is the area that is risky, so we multiply with the risk. Thank you so much. Now, I wanted us now to look at this particular one. So we are saying that now the ratio has changed. So we have debt 40, and then we have equity, which is 60. As you can see, it is different from the original, which was 30 and 60. This one had got a better 1.6. You are told like that. And now we are saying, because of the additional debt, even the risk, which is better, could have changed. That particular risk, we need to define it now. So what is the new risk in this scenario? So we are saying that our BL, using the Amada's formula, is, you are calculating it like that, you have gotten like that, right? Plus so our new BL with this ratio must have changed here. So we're going to have our 1.23, which we have calculated, into 1 plus, this one is 0.7, right? Into our new D, which is 0.4 or over 0.6. Calculate for me this and tell me what is the new beta. We have 4 minutes left. Need to do very fast. What is the new beta?
Dennis, I understand it. We have few minutes remaining, but how did you come up with that, Nini, with the formula that you're using in Roman 3? See, I think we were going to calculate the work just as the same way we did it in Roman 1.
And for you to calculate the work, you need the cost of equity for this new, for this kind of leverage. So we have a new leverage. and you need the cost of equity for this new leverage. And that cost of equity requires you to get VEL using KASNEB. Tunaelewana? We require.
Oh, understood.
Umeelewa, thank you. So we are having 1.804. So this 1.804, we can now calculate our new cost of equity because of the change in leverage, which is now RF. We have written that formula several times. RF plus the bracket ERM minus RF beta of now levered fund. So we can now calculate that. So can somebody help us with this? Our 10% still remains plus 25 minus 10. The only thing that has changed in BL is now 1.804. So you can see that because of the increase in debt, the leverage has moved from, the risk has moved from 1.6. It is more risky. It's more risky. When you increase the debt level, the risk increases. And we know that the value of the farm also increases. Right? So proceed and get me KE. 2 minutes to go. At 7.06. So we have 37.06%. Now we can proceed and calculate our work. So our work is now equal to, this is the equity. So the weight is now 0.60 times the cost, which is now at 7.06 plus, this is the new weight, plus our weight here is 0.4 times. Are we given a new debt? Cost of debt still not given, so we use the same one which we used the other time, which is 10 times. What are we having there? 0.7 still, because it is KE into 1 minus T. So this one is 1 minus T, right? So you can proceed. And then we finish. We can now go and cook, or we go and rest, or go and drink something healthy. 0.6. Thanks so much. Thanks so much, Topista. Those who have tried to follow at the end. So up to this point, you shall be given, you shall be getting some few marks that can allow you pass CPA. We can stop there. It's 1 minute past time. Those who join late and those who miss, please feel free to ask for videos. Some of these things we might not have enough time to go through them again. Might not have enough time. These are just a revision, trying to revise some few things, some simple things. Is there any new person here? I can see somebody by the name Dan. Feel welcome. Feel welcome. My name is CPA Dennis. For more classes, you can get that through 0726 0720 525 000 20525 0. Then you join class. I'll teach you AFM. Somebody's asking whether we have a LEM. Yes, the teacher is around. You can take a break kabla anze. next semester. Feel welcome. Thank you so much. Okay. So thank you so much, guys. I can close the meeting. Let me end the meeting. Florence, make sure that Agatha joins us in our class. Make sure that Agatha joins us in class. Okay.